and thanks for tuning in to Mirror Now. Welcome to another episode of Investor's Guide, where we help you understand all about saving, investing, and how to make your money work for you. And of course, you can get all your personal finance related questions directly answered by the experts. So whatever your question, send them in. You can email your questions to us on investorsguidemrn@gmail.com. You can call us on 022-2499-0546 or simply connect with us on Facebook or Twitter. All the details flashing on your screens. And let's quickly get to today's show. Joining me on the show is Kartik Jhaveri, Certified Financial Planner. Kartik, thanks so much for joining us on Investor's Guide. Kartik, today's show, of course, we have a whole lot of questions, but I really want to focus on new investors, on advice for first-time investors, because we've been getting a lot of questions from investors people who've just started working, people who want to know more about financial planning, how to start, how to go about it. And that's really the focus of all our questions today and the focus of our discussion as well. So when you're starting out, what's the first thing you would say to somebody who comes up and says that I have, maybe 1,000, 2,000, 3,000 rupees that I want to put in every month. I don't know anything about investing. How do I start?
So that's really true, because I love to answer this kind of a question, because people who are first time going to step onto that journey of starting to make their millions, and anyways they are already so exposed to everything around the world. So they know what a million is, they know what a billion is, they know what $1 billion is, what a billionaire is, they know all of it. So there is just three things I want to tell you to all the young people who are listening onto this show, and also for the others who are listening to the show who want to start their journey. And if you haven't done it so far, maybe this is the time. So one is go maximum. So what that means is every 10,000 that you can deploy, and see, you've got traditionally three areas of investment. One is fixed income, the other is equity markets, and the third is real estate. So fixed income obviously is very conservative, and I'm going to talk about that in a moment. Equity market is the place that you can go, because even if you have 1,000 rupees, you can take advantage of that. It's the best creator of wealth for the last 30 years. And the third is real estate. So go maximum. Every time you think about a 10,000 that you can deploy, it is almost translating to something like 2 crores at about 20 years time. Think about it. If you're 25, by the time you're 45, and if you have 2 crores behind you, think about how many options you have at that point of time in life. And this is just with a mere 10,000. Do the mathematics, whether you can do 20,000 or if you can do 2,000, whichever way it is. So go maximum. Try and do as much as you can. Two, do not be aggressive. Do not be conservative. Be super aggressive. Go to the equity market. Don't go PPF. Don't need to do provident funds. Don't need to do fixed deposits. Just go aggressive. And you go smart. If you want 5 things in life, make 5 separate buckets. Put a little bit of money into each bucket and start an investment plan for each little bucket that you have and for whatever you want to do.
Absolutely. In fact, let's take the first query here coming in from Rishikesh Asadkar, who's 22 years old, says, I'm an engineer working in an IT firm. I have started investing in mutual funds, 5,000 rupees per month as SIP in the following funds: Axis Multicap Fund, L&T Midcap Fund, ICICI Pru Multicap Fund. Do I need to make any changes? I want to invest another 5,000 rupees per month. Which mutual funds should I invest in? And is it too early for me to invest directly in the share market? Kartik, again, a young investor here has a couple of funds in hand. We'll keep the share market question for a little later, because that's, again, a couple of questions that have come in about, youngsters wanting to start investing in the stock market, which perhaps may not be the right thing to do. But we'll get to that in a bit. First, your advice for Rishi.
So the funds that he has, they are fine. There's no problem. And when you're starting off your investment journey, multi-cap is a great idea to go with, because what happens in a multi-cap fund, you have a few large blue chips, you've got a few mid-caps which have the potential to become large blue chips in future, and you have a few small caps as well. So the fund manager is quite nicely distributing your money across various categories of the stock market investment universe. So which is why, great idea. Now, you're already doing 3 funds. It's enough for you to just double it into the same 3 funds. Because even if you had 5 crores of investment, I would still say invest in about 4 to 5 funds. Every fund, please understand, has got 30 to 40 different stocks inside it. And then when you have 5 of them, you're going to have 5 into, say, 40 stocks, each 200 stocks. Even if you remove 50% for duplication, you're still with 100 stocks, and that's quite a large portfolio to have. So do not try and have a multiple number of funds in your portfolio, because over time it will get very, very difficult administratively to handle capital gains and all of that. Stay simple. You have 3 funds going, all 3 are great, no change required, double your investment. Whatever you're doing in this, just double it on that.
All right. Well, Rishi, hope that answers your question, and we'll answer your question about the stock market as well in just a little bit from now. But Kartik, coming back to the kind of advice that one gives a young investor, when somebody says that, they've started working, they want to invest a few thousand rupees a month, how important are the other aspects of ensuring that insurance is in place, ensuring that a contingency fund is in place? How much weightage would you give all that at this stage?
So much so weightage, Avdi, that till the time you don't get all that out of the way, you should not even start into investing 1 rupee of your money. So like you said, contingency fund. Now you look at your situation and your job scenario and the skills that you're required. Maybe you think you can get another job in 3 months' time, or maybe it's going to take you 6 months' time, or even a year for the kind of skills you have and the level at which you are to get a new job. So the amount of time that you think you're going to be out of a job, those many months of expenditure. So if you're, for example, spending 20,000 a month, and if you think you'll need 6 months to get a good job, so 20,000 into 6 is 1,20,000, should be your contingency fund, should be sitting in some fixed deposit or a liquid fund for you. A. Second, your health insurance. No matter what, your health insurance has to be in order, because think about it, if you get out of a job, you're in between jobs, and if you have hospitalization, you or your family members, your spouse, your children, that could wipe out literally everything that you've got before you. So health insurance, number 2, and number 3, life insurance. Till the time you do not have these 3 things in place, do not even start with 1 rupee of your investment into the stock market or fixed income market or even a fixed deposit. You have to get these 3 basics in order first, and then you start your investment journey.
Right. So assuming that, so you would advise in that case that, say, the first few months of your, the amount that you can save in the first few months goes towards your insurance and goes towards your contingency fund, and then you start putting in that extra money into a mutual fund, perhaps?
Yes, perhaps, So even if you did do a contingency fund, let's say you're living with your parents, you don't need to worry so much. Don't go mental over the whole idea. Start your journey. But while you do that, health insurance, number 1 priority. Even if you, for example, did not do contingency, did not do life insurance, out of the 3, to my mind, the most important is health insurance. Because if you've got your health, you are capable to earn whatever money you want whenever. But if something happens to health, and if you are hospitalized or disabled or anything of that order, then that's a serious trouble. So yes, get your health, and it's not too expensive, you see. If you had a 10 lakh kind of a policy for the rest of your family, if you are, say, early 20s or 30s, your premium's going to be like 10, 15,000. It's not so much. And you have the option of doing half yearlies and things like, mostly it is annual, but it's difficult to find a half yearly product. But just do that once, and you have to only pay that once in a year and get it out of the way, and then start your journey. Then maybe you start your investments. And if you don't want to start your life insurance, okay, suspend it for a year or so, but definitely do it before you take any loans.
Right. And one more point of clarification, Kartik, in case you already have a Mediclaim policy from the company that you're working for, how important is it to have a separate one where you're not dependent on your employer?
So in today's day and age, my experience is that everybody who's under the age of 30 wants to change their jobs literally every year. I'm making a sweeping generalization of sorts here. But if you fall into that space, then you need to have your private health insurance, because you see, you will get companies' medical benefits so long as you're an employee of that company. You move to another company, you move into a smaller company which may not have that facility, but you're getting a better pay, you're still going to move, and then you're going to ignore the fact that you don't have the health insurance cover. So judge this whole thing yourself. If you're working with a large MNC firm or a large banner, then you will have a great program. If you intend to stay in that company for the next 5 years, okay, you can be a little bit relaxed about the whole thing. But if you are going to be in a situation where people change jobs very often, with the slightest of trouble at workplace, or slightest of ego issues, or slightest of human dynamics playing out, if you are amongst those people who think that you will change a job, by all means you should have your personal health insurance, because you're putting your family at stake while you're already putting your career at stake on one side.
Absolutely. All right. On that note, let's get to the next few questions. And we're going to club the next 2 or 3 questions because they're all more or less from very young investors who've just started off, and they all want to start investing at this point. So we've got a question from Webhav, who's 23, says, I've just started working 8 months ago. I want to invest 1,000 to 2,000 rupees every month in mutual funds. Which schemes can I invest in? Another question comes from Aniket Dangle, who's 20, who says, I would like to invest 1,000 per month for the next 10 years. How should I invest? I have no knowledge about investments. And we've also got a query from Manvi Sinha, who says, I want to invest 2,000 per month for 5 years. Where should I invest my money? So, Kartik, all of them young investors, perhaps who've just started working, they probably, have enough 1,000 to 2,000 rupees to spare a month, which they want to start investing. And it's really heartening to know that at the age of 20, 21, 22, there are people who are looking and who have the focus and the maturity to say that this is important and I need to start doing this now. But what's your advice for them?
So this is obviously very, very encouraging. And if you guys start investing journey right till the time by the time you're 20, 22 or 25, think about it. 1,000 rupee that you invest and you keep doing that for the next large part of your working career, by the age of 50, which is about 30 years down the line, your 1,000 rupee SIP will equal to 70 lakhs. Think about it. You see, so let me give you the mathematics first. I did a little bit of, quick numbers. So 1,000 rupees SIP, if you continue doing that for say 5 years, you'll accumulate 1 lakh rupees. You do it for 10 years, you accumulate about 3 lakhs. You do it for another, say 20 years, you'll end up with 15 lakhs of corpus. Continue doing that for 30 years and an astounding 70 lakhs from 1,000 rupee SIP. So do not think that 1,000 is a small amount. You can do a hell of a lot. A great amount of wealth creation can happen just by a mere 1,000 rupees. But start the journey. All right. Having said that, the best way to start journey is a mutual fund, because like all of you have been asking, if you don't have knowledge about where to invest, how to go about doing things, you earn money, you spend money. So every month, let a nice, good EMI, so-called EMI, which is called an SIP, let it go out of your bank account, direct debit, and go and buy a multi-cap fund. A multi-cap fund is a beautiful idea because it gives you the best of all the worlds. When you're starting off, you want to have a little bit of money in ABC, but instead of having separate investment products running, one product takes care of it for you. And that's why multi-cap fund is a pretty good idea to my mind. Start your SIP there. Continue it, make a systematic investment every month. But remember one thing, do not stop it. The stock market does not go in a linear fashion. It just does not go up like a rocket. So it goes up and down, but stay with it. You'll end up with a huge, huge packet at the end of 20, 25, 30 years.
Absolutely, Kartik. And I want to, just take a moment here, and those numbers that you talked about, that really explains to investors the power of compounding, because that is something that is so important, and it's extremely important to understand where it can really get you. So if we can just get those graphics up on our screens for our viewers, in 5 years, 1,000 rupees every month at a 15%, assuming you're getting 15% returns on that 1,000 rupees. In 5 years, that will be 1 lakh. In 10 years, that will become 3 lakhs. In 15 years, 15 lakhs. And in 30 years, 70 lakhs. Those are the numbers. That's as much as you can accumulate with only 1,000 rupees a month for an extended period of time. So just imagine what can be accumulated if you increase that 1,000 rupees, because obviously as you grow, your income is going to increase. So obviously you can start putting in more money.
Very
so the power of compounding really kicks in as you grow, as you keep increasing the amount of money you set aside, Kartik.
Absolutely. So therefore, don't think that, I need to have 20 lakhs to start my investment journey. 1,000 rupees is enough. In today's world, you can even do 500 rupee in SIP. You can even start with as low as that much. I mean, if you are in the hinterlands, as much as even 100 rupees. So don't think that 1,000 is too little, but start it. Because if you don't start it and you keep waiting to start with that, figure of 20 lakhs, maybe you'll lose about 20 years of your life and you'll realize you don't even have 20 lakhs behind you. But your 1,000 rupees itself will become like, boon boon se sagar bharta. It's going to be something like that. So small drops of your investment will make a huge ocean for yourself.
All right. Then we've got a question from Aditya Kochakan, who's again 20. Says, I earn 20,000 rupees per month. Both my parents are working and financially secure. how much should I invest and where? Well, Kartik, Aditya here, he's quite lucky here.
I know.
Doesn't have to worry about his parents and has a good chunk to sort of perhaps put in. And this is the age where he can probably put in, I mean, without taking away from the enjoyment of having financial independence and starting to earn, but you can put away a good chunk of your money.
Absolutely. When I started off my career many years ago, my salary was about 8,500, and from that I used to do a 4,500 SIP. So, you know, the answer to your question, Aditya, is invest 100%. If you have no other liability, no other expenses, do 100%. But as a general rule for everybody who's in that space, who's starting out, does not have so much of responsibility, there are parents to take care of you, you're pretty comfortable, you know, try and put away at least 40-50% of your money, because I'm assuming that you'll need some money for personal expenditure, have fun, you know, take an EMI if you want to, buy an iPhone if you feel like doing that, and so on and so forth. So don't compromise, but at the same time, don't sort of overspend where you are actually, you know, spending future earnings. So whatever you have, go ahead, enjoy your life, but try and do at least 40%. If you do 40%, you know, you'll end up in a very sweet spot in about 10 years' time, and all your friends will be in complete awe of what you've created in just 10 years' time.
Right. And Kartik, you know, that's the other point. I mean, when one starts earning, you tend to feel, you know, obviously financial independence, you want to buy things and do things. But at the same time, you need to deal with that in a sort of a very balanced way and ensure that you don't overdo it and you don't sort of find yourself out of money at the end of every month. How do you ensure that you're not overspending, that you don't find yourself at the end of the month without any money, looking, you know, at hoping for your next paycheck soon?
So that's a very pertinent situation, Avni. So what happens here is, you know, often when we spend, we don't realize that we need to save something, we need to invest something. So people tend to spend, and then they feel that, you know, when my expenditures get over, when my EMIs get over, I'll start the journey of investment. But it has to happen from day one, because only then can you manage all the loans. It's actually ironical. So therefore, maybe I'll give you a little bit of a rule of thumb, a guideline of sorts, if you like. So out of your money, minimum 20% has to get saved no matter what, which means you've got 80% to do whatever you want. Now, out of the 80% money that you will have, the maximum you're allowed is 50% for EMIs. Now, if you're going to borrow, let's say, especially for a house or for other luxuries or whatever you want, car loan, you know, bike loan or a phone loan or anything that you do, all your EMIs should not be exceeding 50% of your income, because then the remaining 30% is for your personal expenditure. So if you sort of break up your 100 rupees into, you know, 20, 30 and 50, so 20 rupees, number one priority, put an SIP, invest it. If you don't like the stock market, no problem. Go to the fixed deposit, do a recurring deposit, but put away 20% of your money. Very important. The remaining 30% is for expenditure, remaining 50% for your EMIs. And if the lesser EMIs you have some space in that EMI's 50% chunk, then go ahead and start another investment out of it. Because those things will help you to buy bigger things later on. If it's a one bedroom, you might be able to buy two. If it's a mid-sized car, you'll be able to buy a luxury car. All these things will happen, but the question is that you start putting away this 20% first.
Right. And Kartik, of course, that's the other thing, that the importance of holding on to what you've invested in for a long period of time, and not sort of at the first, you know, want of you wanting something else or something to indulge in something, just removing all your money, removing your investments. That's something, again, that needs to be ensured that you don't end up doing that, and you keep your investments on for the long term until and unless there's an actual emergency.
Absolutely. We've all learned this in school, right? As children, we learned rolling stone gathers no moss. So if you invest your money, take it out, invest it, take it out, you're not going to go anywhere. Whether it is you who's 20 or 30 years old, or whether there is somebody who's 50 or 55 years old, there are enough people who keep investing, keep removing, keep investing, keep removing. And in between their investment and removal cycle, which is as short as maybe 6 months, they expect some magic to happen. You know, these kind of people will never ever make anything. So, you know, when we say long term, it's more a disciplinary thing, not really so much, you know, in terms of this is the rule of investment. Yes, investments will take time to mature. The whole idea is, even if it's a fixed deposit, now there's no stock market volatility in a fixed deposit, but if you make a fixed deposit, take it out in 6 months' time, you're not going to really earn anything. So if you want to earn a larger interest, if you want your money to make money, then the idea is you got to let it grow. And it's a sense, it's a behavior, it's a discipline that you need to have. So therefore, whether it's the fixed deposit or whether it's the stock market, in both the cases, once you invest it, you need to have that basic investment behavior of not touching it for some time. So therefore, don't even go overboard and try and be too greedy and invest everything, but make a plan, invest what you can do. And like I said a while ago, 20% should be bare minimum. If you can do at least 20, then that's good to start with. And then as your income goes up over the years, try and reach a much higher figure. Because as income moves up, your expenditure does not move up in the same linear fashion. There is a larger gap. So if your income went up 50%, your expenditure might go up maybe 20%. Don't try and make it 50%. Even if you try, it may not happen. So you'll have some surplus. You'll have extra surplus. So go ahead and make some investments.
All right, we've got a question from Monty Jangid, who's 28, says, I want to invest for 1 year. Which investment option is better, fixed deposit or mutual funds? Kartik, it's a short-term investment horizon. So assuming he's talking about debt mutual funds. So between a fixed deposit and a debt mutual fund, what would be your advice?
So at the moment, go to a fixed deposit, I would think, because if you know your time frame very, very clear that in 9 months' time or 12 months' time, I'm definitely going to withdraw, then make a fixed deposit. If you are kind of a little unsure about the time of your withdrawal, then go to a debt mutual fund, which is a liquid fund or a short-term mutual fund. The reason for that is in a fixed deposit, you'll get charged the exit or early exit sort of a penalty charge, and that would reduce your interest rate. But in a mutual fund, that won't be applicable. So therefore, if you're not sure exactly on the date and time of your withdrawal of funds, then short-term liquid funds. And if you're pretty sure that you're not going to touch it for 6 months or 9 months or 12 months, then do a fixed deposit.
All right, we've got a question from Govind Raj, who says, how should I go about beginning my investment planning? Well, Govind, this entire episode perhaps has been answering all of your questions. But Kartik, specifically, if you had some, in a nutshell, if you had to tell somebody how to start, what would you say?
Firstly, don't listen to friends and philosophers. Basically, look at these kind of shows where you get unbiased advice on how to go about investing. Second point is don't get greedy. So if somebody says this is a fantastic investment, maybe it is. And maybe you want to believe him completely. And maybe you do trust him completely. But still don't get greedy and put all your money on that one day. Break your money into smaller parts and take your time to invest that money. You can keep the money in the savings account and keep investing every month, every week, whichever way you like. If you are working with a financial advisor, maybe they'll make a plan for you. So your 100 rupees will get deployed into maybe stock market, fixed deposits over a small period of time. But whenever you invest, break it up. Don't do everything on one stroke. Don't put all your money into one category, whether it is a fixed deposit or whether it's an equity. Spread it out.
All right. Well, we've got a caller on the phone line, Mrs. Falero, who's calling us from Mumbai. Thank you so much for calling us. Go ahead. What is your question for Kartik?
Actually, I have 12 grandchildren. I want them to invest in them. They've all started working, and I want them to invest.
Right.
So I myself don't know much, but listening to your talk now, I thought of investing, teaching them to invest. So I just wanted to a guideline. He says 1,000 or 2,000 into SIP.
Yes.
Now SIP, I didn't get the full meaning of SIP, and where do I put that? Where is this SIP available?
Right. Well, Mrs. Falero, SIP simply means systematic investment plan, and it's a way to invest your money in mutual funds, essentially. So, the best idea I would suggest for yourself and your grandchildren is to, maybe watch this kind of a show, approach a financial planner, somebody like Kartik, who's there to help out and give advice on how to start investing, and that would probably help. But Kartik, anything you would like to add for Mrs. Falero?
Yeah, so, a lot of times everyone is quite comfortable and used to the idea of a recurring deposit, because we've been doing that for decades, if not like a century, because banking has been around for a long time. So just the way every month you are putting in some money into the bank deposit, in the same fashion, when you make a monthly investment into a mutual fund, and mutual fund has given you a convenience concept called SIP. So which means if you did not have a situation where you had lump sum money and you wanted to invest in parts, you tell the company that I'm choosing this particular fund, this scheme, and I'm going to invest in small installments of 2,000 every month on a regular date. So every month on a regular date from your bank account, the money gets debited and your SIP account gets credited. And therefore you will buy some units, and that's how over a period of time, slowly, you're buying a little by little, brick by brick, you're buying the piece of the stock market. And as the shares of that particular fund grow in value, the NAV of your mutual fund will also grow. So like Avni said, you can approach a financial consultant, you can approach your bank. There are lots of people who can help you do that. You can even do it directly. There are lots of mutual funds. There are almost 40 companies registered in India. A lot of them are doing great. All the household names are in this business, whether it's HDFC or whether it's Tata's or Reliance or Birla, etc. So you've got all of them. You can even, if your grandchildren are comfortable doing online, you can even go to the website of these companies and initiate it online. It's really simple, a couple of buttons and you could be done, or you could simply approach an advisor and he could do it manually or electronically, whichever way you want.
Right. All right, Mrs. Falero, hope that answers your question, and do write back to us or call us again if you have any further questions on that. And Kartik, we've got time for one quick question, perhaps, or probably a last word, because we've got this other question from Veeramani who says, I want to invest in the stock market. How do I approach the market and how can I get started as a beginner? A quick word on, youngsters investing directly in the stock market, perhaps not something that should be advised at this stage.
So, very quickly, I'll also answer your question, Avni. When you're investing in the stock market, you have to know about what you're investing. So you need to do a little bit of research about balance sheet, profit and loss, hear about the company, do some study, do some research, understand where you're doing. But let's say you don't want to do any of that, okay? Then there are two things that you must do. One, you should not listen to any tips from anywhere, no matter what it is. And number two, you should buy a basic large cap company. Large cap means a blue chip kind of a company. Maybe, products that you're using every day around you. Just sit there from your morning to evening, think about the products that you're using for like last 20 years.
Right.
Things that you're using to brush your teeth, things that you're using to paint your house, things that you're using to wear clothes. I mean, these are companies that have been around for a very, very long time. So buy blue chips if you have to do it yourself. Buy one share, buy two shares if you really want to do that. And if you want to go smarter and go deeper, then start understanding and learning balance sheets, read profit and loss. Company that makes profit will make a lot of profit for you if you buy the shares of that company.
Or you could simply invest in mutual funds as well. All right. Yes. On that note, Kartik, thank you so much for joining us with answering all of those questions and all of that advice. That's a wrap on this edition of Investor's Guide. But do keep writing to us, no matter how simple or how complicated your question is. We're sure to get it answered right here on Investor's Guide. Until next week, thanks for watching.